Hi and welcome to Swissquote's Daily Market Talk. It's Friday, the 22nd of August. Risk appetite remains limited into Jerome Powell's most awaited Jackson Hole speech today. Will Powell maintain his cautious view regarding the rate cuts due to looming inflation risks in the US, or will he give in to the weakening jobs data and signal a dovish shift in the Fed's policy? So what he will say will likely determine the market's next direction. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the selling pressure across most major US and European indices continued yesterday. There is no major progress in peace talks for Ukraine, and the hawkish risk to the latest dovish shift in Fed expectations persist big time. So yesterday's weekly jobless numbers from the US and the Philly Fed manufacturing data came in line with the ongoing worries of investors of slowing labor market and rising price pressures. And remember, the Fed minutes earlier this week also showed that the Fed members were more worried about inflation risk today than labor market weakening. So even though, as we talked about it yesterday, the Fed meeting was held a few days before the drama over the August employment numbers in the US, remember, some Fed members still renewed their cautious stance regarding immediate interest rate cuts in the United States. So the Fed does, are no longer so sure that the Fed's September monetary policy meeting will bring a rate cut. So the probability of a 25 basis point cut is down to 75%, down actually from 100% chance assessed to a cut last week, a 25 or a 50 basis point cut. So the mood changes in the market can't be ignored, and there is a good reason for that, because with the release of August jobs numbers in the US, all of a sudden, the job additions for the trailing 3 months went from around 150,000 on average job additions, which is more than correct actually, to around 35,000, which starts being alarming. And the market narrative, parallelly went to the US jobs market remains so surprisingly resilient and healthy in face of the trade and AI risk to cracks are actually showing and the Fed may actually be falling behind the curve. Meanwhile, on the inflation front, the CPI data actually showed last week, remember, that consumer prices in the US remained in control, but then the producer prices started to show the tariff-led pressures. And this week, big US retailers reported their earnings, and their second quarter results actually hinted that consumers are increasing their preference for discount stores and smaller ticket items. And even though the companies said that consumer demand remains somehow healthy in the US despite the tariff risk and the tariff pressures, Walmart now restocks its shelves apparently with pricier goods due to the tariff pressures, and that should actually start showing in the CPI figures sooner rather than later. So here we are right now in terms of inflation and employment markets. On one hand, the US government, with Donald Trump himself, is pushing for lower interest rates to cover up the impact of the trade war on the US jobs data and the economy. And on the other hand, the Fed is, kind of willing to make sure that an interest rate cut in the US wouldn't boost inflation amid looming tariff effects on inflation. In theory, the Fed should address inflation issues first before attacking issues in the jobs market. This is how you get a healthy economy in the medium to long run. But inflation has been surprisingly resistant to tariff-led hikes so far, as companies try to push back on additional tariff costs as far as they could, while the cracks in the jobs data are already apparent. So what Powell will say today or will not say will matter for investors. Powell may not actually say much more than they will be looking at the economic data and decide the next steps about the monetary policy. But because Jackson Hole meeting has served as a platform to announce important monetary policy shifts in the past, the potential surprise factor actually makes Jerome Powell's upcoming speech at the Jackson Hole, a broadly anticipated and watched event. And oh, by the way, the world's leading bankers and leading finance officials will be diving into the transition of the labor markets of these days in their Jackson Hole meeting. And it is well possible that we will hear what's the most recent take on AI's impact on the future of trends across the jobs markets around the world. So the latest Fed minutes did mention actually that risk that the increased use of artificial intelligence in the workplace may lower employment. But whatever it is on the menu of this year's Jackson Hole meeting, the investment world will be watching and watching very closely. A cautiously hawkish tone from Powell today could lead to a further trimming of the earlier extra dovish Fed expectations, and the latter could upset risk traders around the world and encourage them to take profit and move to the sidelines into September. In concrete, we could eventually see the US 2-year yield further rebound in case of a hawkish surprise. The S&P 500 could further slip. The rally in small cap values in the US could stall, and the US dollar could very well extend its latest recovery. Now note that the rising long maturity yields, especially the Japanese 30-year yield, increases the chances of a deeper global sell-off if investors are not pleased with what Jerome Powell will say today. For now, the dollar yen is not necessarily showing signs of a particular stress, and that's something good, I guess. The US dollar, on the other hand, recovers into Jerome Powell's most awaited Jackson Hole speech as traders are trimming the extra dovishness of their positions, as I said, and the euro dollar is now below the 50-day moving average on the back of a broad-based US dollar recovery across the board. The pair now looks toppish after this week's slide, but on the data front, the euro area's manufacturing PMI unexpectedly printed a number above 50. So that's pointing at expansion in the Europeans' manufacturing sector for the very first time in more than 3 years. That's good news, and that expansion was probably thanks to higher new orders as a reaction to reduced tariff uncertainties. And now that we have a tariff rate of 15% to base the business and export decisions on. Plus, the news that the European Union and US are making further progress on trade negotiations are also very much supportive for the region's growth outlook, mind you, in addition to a broadly anticipated gradual positive impact of the military spending across the Eurozone economies, an impact that will be more visible next year in the economic data than this year, according to the European Central Bank. So that positive outlook for the Eurozone economies also maintains appetite quite strong for the Stoxx 600 stocks, but may hinder the European Central Bank's ability to cut its interest rates in the coming months, as higher growth for the Eurozone could also lead to higher inflation. For now, the view for the European Central Bank is steady as it goes. The European Central Bank will likely bypass the September meeting and not announce a rate cut, and could even refrain from announcing a further rate cut later this year, depending on inflation and depending on the tariffs' impact on the economy. If the European Central Bank doesn't see the tariffs impact the economy too much, well, it doesn't have a reason to continue cutting the interest rates. Still, the Stoxx 600 index remains a solid alternative, mind you, for investors diversifying away from the US stocks these days and reducing their exposure to technology holdings. So the Stoxx 600 erased all its tariff-led losses post-April and is set to advance toward fresh highs back to euro, given that the single currency actually benefited grandly from the narrative of extra military spending that could lead to growth and a broad-based debasement of the US dollar. We may soon see a peak in the euro dollar if, of course, the US dollar appetite returns into full, supported by a hawkish awakening among the Fed watchers. So Powell will be saying the last word this week, and we will all be listening very carefully. But this is all for this this week's Market Talk. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.